Hi, this is ProACT Sam. Welcome to this webinar. And this week we're discussing um, how much is capital gains tax and how can we plan to save that. Now, this is a series of webinars, live webinars that we're doing this month at the end of 2021 to look at how specifically we can consider UK capital gains tax rates and compare that for expats, so that an expat who's got a liability in the UK, uh, what is the capital gains liability, and if somebody is in the UK and they're considering going expat, how can they save that tax by looking at a jurisdiction abroad? Specifically, today we're going to compare capital gains tax for expats with a tax residence in a jurisdiction like Cyprus, for as an expat residence for business and family, for nomads, for contract workers, for personal service company operatives. So that's what we're looking at today. So let's dive right into it. The first thing about when does capital gains tax apply? Well, that's a very, very interesting question. Because it depends upon your tax residence. So first of all, where are you tax resident? So if you're living and working abroad already, then you're not tax resident in the UK. So if you've got UK assets, then capital gains tax might apply. And the rules today are not what they used to be in the past, and we're going to cover that later on. If you're operating through a personal service company or through a company or on an employment contract, then the situation becomes slightly different. And you've got some considerations to take on board then. The first thing that you need to consider is where the permanent establishment, where the work is taking place, as well as what your individual liability is and what the contract situation is with your employer. So all these things need to be kept into consideration, and it varies country by country. So in essence, there is in law a 90-day rule where you can undertake short business trips, short into any country, work there and not incur a tax residence or a tax liability. But that varies country by country. It could be that you are changing your circumstance, and you could be a tax resident as an expat, but still be liable to a capital gains tax in the country where you're tax resident, even if that capital gains liability applies elsewhere. The reason for this is that capital gains tax is often applied on fixed asset basis. And this is some of the big changes for expats with regard to UK tax on gains over the last few years. If you go back 10 years, a UK resident could go expat and then dispose of business and property and investment assets in the UK and receive a relief against that, so that they're exempt by staying out of the country for more than 5 years from those capital gains taxes in the UK. And that could have a big saving on that. In the UK, you've got a business entrepreneurs relief, but it's still 10% on the business that you sell. So big entrepreneurs selling a 10 million, 100 million pound business can save a lot of capital gains tax by going expat in the old days. Those rules have changed quite considerably, culminating in the current rules that have come into force in full from April 2020 for expats with UK assets. The basic capital gains tax rate in the UK is up to 20%. So at a basic rate tax level up to 50,000 income approximately in the UK, capital gains tax is 10%, and then it goes up to 20%. But there's now a separate rate for residential property. Doesn't matter what you're doing with that residential property, unless it's your main home in the UK and nominated as your main home, possibly. Even if any form of commercial activity with the property will mean that the property will fall under capital gains tax rules. So on disposal, within 2 months, you have a liability since 2021 to pay capital gains tax at up to 28% on that UK property disposal. So that's quite a significant liability and a big change for people. So an expat cannot leave the UK, sell UK property and avoid capital gains tax. That will still apply at up to a higher rate of 28% or a basic rate of 18%. So there's quite a lot of planning needs to be done. And people caught with a UK residential portfolio where they're letting properties, they are caught now since April 2020 in a tax assessment for the gains on that property. And from October 21, even expats disposing of that property must report that within 60 days and pay any tax that's due. If you're selling a UK property which owns property assets, then the capital gains tax liability will still apply. However, an expat or a UK resident can leave the UK, become non-resident to the UK, become expat. If they're disposing of shares or investments, including unit trusts, they would be exempt from capital gains tax. So if you've got financial investments, stock market investments, cryptocurrency investments, and you go expat, then you can avoid any liability to capital gains tax on those profits, given that, again, your tax resident is of essence and you must be non-resident in the tax year before you consider making that disposal. The business assets as well, that are potentially going to business assets would get taxed. So the shares can be avoidable, but if it's a personal business sale, with business to business, then it can be still capital gains tax. But intangible assets and fixed assets of the company, movable assets of the company, can still be suffering from UK tax on capital gains. So there's much to be avoided, and there's some small reliefs in the UK. There's an annual personal allowance. With the UK property, complicated slightly, but the rebasing of property value. So you could have owned a property for 20 years in the UK, residential property for let, that is now subject to capital gains tax, but the price was rebased possibly to April 19. So it's only the gain that you've made since then, but there's no indexation on that. So it's quite a penal tax on UK residential property. So expats and investing in UK property need to consider how they can mitigate that. So there's annual allowances for a gradual sell-off and liquidation of assets, or it's gifting that can be made within a limited family arrangement or to a charitable arrangement. They can give it away, or ProACT could help you create a charitable trust that would enable you to give that away in your own time and still protect some of the capital assets and manage those for your family in the years to come. When we compare the situation with Cyprus to other jurisdictions, sorry, it's my producer on the other device, and I'm just checking what he was saying, but it's actually giving you comments, so thanks for that. Now let's compare capital gains with another jurisdiction, and one that's favourable for expats, and I want to specifically look at Cyprus. In Cyprus, there's no inheritance tax we talked about capital gains tax in the UK. When you die, it becomes inheritance tax. Another interesting point on property, by the way, is that when you die, there's no the gift of property can be passed to a family. Capital inheritance tax can apply, but that inherited property then subsequently potentially liable to capital gains tax as an inherited property. In Cyprus, there's no inheritance tax at all, and there's no capital gains tax. The only capital gains tax that applies in Cyprus is if you own Cyprus residential property. Any investments, any intangible assets, any royalties held in Cyprus is free of capital gains tax, and those disposals. And the tax rate is a flat rate in Cyprus at 20%. So it's comparable to the UK for shares and investments, and it's lower than the UK residential rate of up to 28%. But Cyprus has got some other advantages as well, depending on what you want to do. So for an expat living as a Cyprus tax resident, there's 0% dividend taxes. So if you've got a business which is a property portfolio, it's got a property portfolio, the rental income accumulating in that can be distributed to you as an expat in Cyprus as a rental income, which using dividends to mitigate your liabilities and reduce the overall tax liability. Any company has a corporation tax rate, which is a flat rate tax. Corporation tax for a Cyprus company is 12.5%. For a UK small company, 19%. Some other interesting factors for Cyprus to consider is that the personal allowance is actually quite high, but an expat relocating to Cyprus can get a potential reduction in their income tax of up to 50% for up to 17 years. So although you've got this £17,000 personal allowance in Cyprus and a maximum tax rate of 35%, you can actually pay 50% of that rate for up to 17 years if you're receiving an income from your personal service company or your overseas contract. If you're receiving dividends, the tax is nil. No inheritance tax, no capital gains tax, other than on any Cyprus property that's owned. So if you then extend that and you wanted to be a nomad in terms of your working, Cyprus has other attractions to people. So this is not going to avoid you a capital gains tax, but again, if you haven't got your permanent establishment in Cyprus and you're working from Cyprus, or you're receiving your income from Cyprus from a UK company that's got property rental income, or it's holding capital assets that you want to defer that disposal of, the dividend income would be zero, but you wouldn't, there's no permanent establishment in Cyprus. You've got no social insurance, national insurance liability as well for carrying on that work as a contractor or personal service company. Anybody who is a Cyprus tax resident, but then carries out their duties abroad for more than 90 days, so if you're managing your business or carrying out your contract elsewhere, then again, you've got no liability to the income in Cyprus on that. So you need to be a tax resident. You can be a tax resident in Cyprus as long as you spend at least 60 days a year there. If you're carrying out the duties for more than 90 days elsewhere, then there's no income tax liability in Cyprus. Cyprus can have the individual tax liabilities for the expat based in Cyprus, working abroad or receiving that income from their own personal service company invested in their own assets, allowing a deferment of the disposal of the investment company or the investment assets to defer that liability to capital gains tax going down the road. So the tax residence is of key and can allow you to avoid capital gains tax liability as well as other tax liabilities, depending on where you are. So if you've got a fixed asset in the UK, which is a property or property rental income as an individual, then you can't avoid that liability. If you're a tax resident in another jurisdiction, like Cyprus are not going to add to that tax. You're not going to pay any more tax. So even under the double taxation treaty with Cyprus, you're not going to pay more tax, but you could pay less. So going expat can help you to plan and mitigate and spread the disposal over a number of tax years to reduce the rate. So for UK residential property, you could take it from 28 down to 18%. You can maximise your personal allowances or make gifts. You could potentially create, a trust arrangement, a charitable trust for your family to mitigate the tax liabilities that you've got and spread that over a period of time. So while an investment going expat, you can avoid UK capital gains on cryptocurrencies, investment portfolios straight away. As long as you make it in the next tax year after you've gone expat, you can avoid any liability of capital gains tax in the UK and in, if Cyprus is your country of tax residence, in Cyprus as well. But if you don't do that, you can consider other strategies and other tactics to try and avoid and protect your family's capital and income for the future. So lots to consider, and I'm just trying to highlight what the potential liability is in this webinar for capital gains tax. So even if an entrepreneur is selling his £100 million business after a lifetime's work, there's still going to be a 10% capital gains tax with relief on the sale of that property. If you've built up a property portfolio for renting that's not your main residence in the UK, you've got up to a 28% liability. So the liabilities are high. So planning ahead on that strategy of those disposals, you can either know your tax liability or plan to avoid it going forward. All these issues and these plans, we'll go into it in a bit more detail next week. So join us for next Wednesday's live webinar, and we'll be looking at a bit more detail about this planning strategies where a family and business can make arrangements to spread the disposal rate over a period of time, or potentially mitigate it by timing any split year or any relocation in the right way to avoid an assessment of foreign income in the UK or a capital gains tax in the UK to tax, and enjoying an expat lower tax rate for that. We'll compare different jurisdictions as well as Cyprus and look at maybe Portugal and some other jurisdictions as well to see how capital gains tax can be treated differently even if you're a tax resident. So join us next week for that. If you want a free review, you can contact us at proactpartnership.com or go to our retained client service at proactpartnership.co.uk. Sign up there and you can book online for a free review with one of our team and join us as a retained client to get guidance every step of the way while you're living and working abroad or relocating to avoid capital gains tax and tax residency issues for expats. Thanks very much for listening. I hope you've enjoyed it, and give us a call and contact us. Go online, proactpartnership.co.uk, and we'll see you on the other side. Thank you. Bye-bye.